In this video, I'm going to provide my forecast for where I think US inflation comes in 2025. I'm going to provide details and justifications and evidence for why I think inflation will be where I think it will be. I'll give you the central bank's forecast for where inflation will be. I'll give you the market expectations for what the entire investor community expects inflation to be in 2025. And then I'll provide my outlook for why I think inflation will be where it will be next year. Of course, we've all experienced significant inflation over the last 5 years. It's lowered our purchasing power because everything is more expensive and incomes have not gone up anywhere near the rate of inflation. And so our purchasing power has decreased, unfortunately. So this is an important and critical metric, not just for stock market investors, but also for every consumer in the United States. I quickly wanted to let everyone know about this great offer for my channel members at the investor tier. You can gain access to my spreadsheet containing my ratings on over 130 stocks. I update this spreadsheet with multiple times and multiple changes per day, Monday through Friday. Additionally, channel members at the investor tier can get access to my spreadsheet with my discounted cash flow valuations, and I update this spreadsheet multiple times per week with multiple new companies added to this spreadsheet with discounted cash flow valuations. There's already dozens on the spreadsheet available now. You can get all this plus early access videos, plus member exclusive videos, plus priority response to comments, all for less than $15 per month. So what are you waiting for? Hit that join button below and start experiencing the benefits. All right, so what I have pulled up here is a table of the economic projections of the Federal Reserve board members of the Federal Reserve Bank and what they feel inflation will be in 2025. And I've highlighted those big numbers here in green and red. The members of the board expect that PCE inflation, personal consumption expenditure inflation, will come in at 2.5%, as well as core PCE inflation will come in at 2.5%. Now, importantly, this expectation for 2.5% inflation in 2025 is up from a few months ago in September, when they thought that inflation was going to be 2.1% in 2025 and 2.2% on core inflation. So just in the last couple of months, the board members of the Federal Reserve increased their expectations for inflation for 2025. Now, the big change that happened between September and December when they made their updated forecast were the major elections in the United States for both the presidency, the Senate, and the House. And the Republicans won all three chambers of government, and that allows them to undertake their desired policy without necessarily help from the Democrats. So that increased the chances of Republican policies like tax cuts in 2025, deregulation in 2025, and other factors that are also inflationary. If the government lowers taxes or decreases tax rates for corporations and individuals, that's considered inflationary because that's more income in consumer pockets. And so, with more income in consumer pockets or with more money in consumer pockets, they will have more money to spend. And when they go out to spend that money, that will cause an increase in prices on various things throughout the economy, including food, cars, and housing, because more money will be chasing after relatively same amount of goods that would have been around without these new government policies. So these new government policies have not been enacted yet. It's just the speculation or the anticipation of these events that have already roiled financial markets. Asset prices across the board are much higher since those elections. Whether you're looking at the equity markets in stocks, whether you're looking at the cryptocurrency markets, whether you're looking anywhere in the economy, prices have increased following the elections. And that's already more wealth in people's pockets, which is going to increase spending already without ever seeing those changes in government policies. Isn't that interesting how the markets already react in anticipation of something potentially happening? But even on that anticipation, asset values have already increased and wealth has already increased, which is already increasing spending in the economy. Interesting, isn't it? Our markets are a forward looking mechanism, and all probabilities are getting priced in today for outcomes in the future that may or may not happen. So we looked at projections. Let's look at history, right? So over the last 10 years, the US inflation rate has fluctuated, most notably since the pandemic. As a result of government policy, inflation soared during the pandemic. And it was obvious that we were going to experience inflation during the pandemic, but policymakers chose to take that risk anyways, because at the same time, governments were forcing businesses to close their doors for in person business, meaning there would be fewer things that people could spend money on. At that same time, they were also sending out hundreds of billions, if not trillions of dollars to people in the US for them to go out and spend money. So you had more money going out, fewer things to buy, and so you had more money chasing fewer goods, and that will always, almost always, I don't want to say with 100% certainty, but that will usually lead to inflation. And so that's what happened. We had soaring inflation, and today, if you compare with 2019, the prices of nearly everything is significantly higher than it was back then. But what we're talking about now is the change in price between 2024 and 2025. And the most recent inflation reading came in at 2.75%. As you can see, it was already a tick higher. We had been seeing a notable decrease in inflation ever since the Federal Reserve started tackling inflation, raising interest rates to try and slow down consumer spending. Because when they raise interest rates, that means things like cars and homes, the monthly payment is going to be higher. And so you're going to be less interested in buying those assets that have a monthly payment connected to interest rates. And that's been working to decrease consumer spending, but not enough to bring inflation down to zero or to negative. Prices are not going to go back to where they were in 2019. All the Federal Reserve is trying to do is slow down the growth of prices, slow down the inflation rate, not return prices to where they were in 2019. And so after significant progress, that slowed recently and the inflation rate rose to 2.75%. Now, if you're looking at market expectations, those have also increased and they are ahead of what the Federal Reserve is expecting. So the US 1 year ahead inflation expectation, in other words, what people in the US expect inflation to be over the next year is 2.97%. So that's higher than what the Federal Reserve is expecting at 2.5%. So the market expects higher inflation than the Federal Reserve does. And it's partly because personal income has continued to increase. Month over month, personal increase in income came in at 0.28%. Annualized, that would be roughly 3.5% growth in personal income. And there's been growth in personal income for a couple of years now. Every month, little by little, incomes are growing and the jobless rate is holding relatively steady. And so people's incomes have increased. And at the same time, people are saving less. The personal savings rate came in at 4.4% in the most recent update. And that's much lower than previous years. And I also wanted to share this longer term 10-year chart with you to demonstrate the significantly structurally lower personal savings that we've experienced post-pandemic. Before the pandemic, personal savings were structurally higher, around 6 or 7%. People were saving for, several years. The great financial crisis made people more prudent with their finances, and so they were saving more. And then we had the pandemic, and you had all that stimulus, and you had those big changes in significant areas. And so that really structurally changed things. And now people are saving a lot less. Just 4.4% in the most recent update. And you can see here 4.4%, and that's been a trend lower here throughout 2024. After a big burst to begin the year, the savings rate has slowed. And that's partly a function of the cost of living rising quicker than personal income. And it's partly a function of people getting out, getting away from home, and living a little bit after a couple of years of being so constrained during the pandemic. So, with all that being said, where do I think US inflation will come in 2025? I think it's going to be between what the Federal Reserve expects and what the market expects. So my inflation expectation for 2025 is between 2.75% and 2.95%, or 2.75% to 2.3% inflation in 2025. There's a number of factors that could change that. There's a number of factors that could push it higher, such as government policy, and there are a number of factors that could push it lower, such as things like moving the economy to a more consumption based on goods rather than on services, because we're seeing more constraint in services than we are for goods. So that's one of the things that could change those factors. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.